Hey, this is Chris, and today I'm going to be discussing everybody's favorite topic, tax. Specifically, tax on ETFs and some of the key things you need to know when managing and preparing your tax for the ETFs that you own. First of all, I need to make a disclaimer here. Stockspot is not a tax advisor. We don't provide tax advice. We're not a tax agent. And we recommend that if you need advice on your tax, particularly if doing a more complex tax return where you don't understand ETFs, you speak to a tax advisor. However, the reason I wanted to do this video is that we've built our own tax engine where we calculate and manage the tax calculations for our tens of thousands of clients. And I wanted to share some of the key learnings that we have from building that, and also some of the key things you need to look out for in managing your own ETF tax. It's particularly important at the moment because last year the ATO Deputy Commissioner came out and said that they're going to be cracking down on a lot of these first-time investors that have started investing over the last couple of years in shares or ETFs, making sure that they're paying tax. And it's particularly important when it comes to ETFs, not that it's not important with shares, because tax generally isn't paid by the ETF issuers themselves, and it's the responsibility of the owners of the ETFs to pay their fair share of tax. And so it's definitely something the ATO is looking at closely. So first tip is that generally ETFs are a form of investment where you need to pay tax in two different areas. So first of all, there is the capital gains tax that you pay when you buy and then sell an ETF for a profit. And then there is the tax that you pay on distributions. So distributions are an ETF's equivalent to a dividend. It's when they pay you out based on all of the underlying holdings dividends or the interest from the underlying holdings. Now this is a little bit more complex when it comes to ETFs compared to when you own CBA shares or Woolly shares, and that's because when a distribution is paid to you as an ETF distribution, there's all sorts of different components that fit within that distribution. And you don't actually find out until the end of the tax year when the ETF issuer will send you the components of the distributions you've received throughout the year. Now those distributions are across a few different areas. So you've got the cash component of the distribution. That's probably the money that you've received in your account over that last year. And that may be a combination of different underlying components. But then in addition, there's a non-cash component of these distributions, which is typically things like franking credits, foreign tax, and this other funky new thing that's come out in the last few years for a lot of these ETFs, which is called the AMIT cost base adjustment. Now, this is the thing that I think is going to throw a lot of people off at the moment, because the AMIT cost base adjustment doesn't just affect your tax for this year, but it actually means that you may need to change or adjust your tax cost base for your investments either up or down, which may impact future capital gains. And so that's something you really need to focus on and get right or get advice on, because it's something a lot of people I know aren't used to. It's quite complicated, and it doesn't just affect this year's tax return, it will affect next year's tax return and the year after. So high level, you're getting returns in a few different areas, capital gains and distributions. The distributions have a whole bunch of cash and non-cash components. And of the non-cash components, some are more obvious, like franking credits, where they'll send it to you on your statement and you can put it on your tax return. Others, like the AMIT cost base adjustment, will actually affect how you account for your holdings going forward. So the last tip I would say is really important to think about is something that the ATO pointed out last year, which is a reminder that you can't claim paper losses. So if you've lost money on a share, and unfortunately I think there's a few people that have lost money trading shares this year, if you haven't crystallized that loss and actually sold, you can't actually capitalize on that loss until you've realized it. And if you don't have a capital gain in that same year, you may not be able to absorb those losses until a future tax return because you can carry them forward. So overall, there's a lot to think about when doing your tax for ETFs. Look, if you're using an automated service like Stockspot, hopefully it's all done for you. We try and give our clients a simple one-pager where we actually delineate all of the different tax components based on our own algorithm of combining all of the different statements. But if you're doing it yourself, you're going to need to get the tax statements from each ETF you own, either pass it on to your accountant or tax advisor, or sift through it yourself and make sure you're pulling out the right components, putting them in the right places, and then adjusting your tax cost base for future years. And in my mind, they're the key things you have to keep in mind when you're managing your tax for ETFs. Look, overall, ETFs are an awesome instrument because they are really, really tax efficient in the long term. However, because some of the changes over the last couple of years, particularly since 2018, tax is getting more complex around ETFs. So if you don't know what you're doing and you're worried about getting it wrong, get tax advice, because you don't want to get in trouble, and it's definitely something the tax office is looking at more closely these days.